Three of the most popular international ETFs are Vanguard's VWO, VEA, and VXUS. Is there one that reigns supreme to hold alongside US stocks? Let's find out. Index investors in the US usually know it's a good idea to diversify in equities outside the United States. At global market weights, US stocks only comprise about half of the global market. International stocks don't move in perfect lockstep with US stocks, offering a diversification benefit. If US stocks are declining, international stocks may be doing well, and vice versa. The US is one single country. No single country consistently outperforms all the others in the world. If one did, that outperformance would also lead to relative overvaluation and a subsequent reversal. The legendary Meb Faber found that if you look at the past 70 years, the US stock market has outperformed foreign stocks by 1% per year, but all of that outperformance has come after 2009. During the period 1970 to 2008, for example, an equity portfolio of 80% US stocks and 20% international stocks had higher general and risk-adjusted returns than a 100% US stock portfolio. In short, geographic diversification in equities has huge potential upside and little downside for investors. What is perhaps less clear is how exactly one should go about implementing that diversification in international stocks. The most popular choice by far is VXUS, Vanguard's total international stock market fund. This fund is a crucial component of both the Bogleheads 3 fund and 4 fund portfolios. Investors may not realize what the underlying components of a broad index fund like VXUS are though, and how those components behave relative to US stocks. VXUS is roughly 75% developed markets and 25% emerging markets, but as we would expect, developed markets are highly correlated with the US market and thus don't offer much of a diversification benefit. Emerging markets offer a consistently lower correlation to the US market and are thus a superior diversifier, all else equal. Of course, we would expect this too, as these developing countries have unique risks, regulatory, liquidity, political, financial transparency, currency, etc. that do not affect developed countries, or at least not to the same extent. As an added bonus, emerging markets tend to compensate investors for taking on these extra risks in the form of higher returns compared to developed markets. For example, consider the decade 2000 to 2009. While this famous lost decade delivered a negative 10% return for the S&P 500, developed markets returned a positive 13% and emerging markets returned a positive 155%. This sort of massive performance difference between emerging markets and the US has been fairly consistent throughout history. When emerging markets outperform the US, they tend to outperform by a wide margin, and when they underperform the US, they tend to underperform by a wide margin. This is actually a good thing for diversification. VEA is Vanguard's broad index fund for developed markets. Its mutual fund equivalent is VTMGX. VWO is the one for emerging markets. Its mutual fund equivalent is VEMAX. Thus, VXUS, whose mutual fund equivalent is VTIAX, is roughly 75-25 VEA to VWO. So for a realistic example where the portfolio has home country bias, as most people do, a 100% equities portfolio of 80% VTI, which is the total US stock market, and 20% VXUS, unfortunately only has about 5% exposure to emerging markets. To remedy this, we have to forego the use of VXUS and use its components VEA and VWO to get more granular. I personally choose to equally weight developed markets and emerging markets and international stocks in my own portfolio to take advantage of the superior diversification and greater expected returns, while still including the many countries in developed markets that may outperform the US during certain periods. Let's look at some historical performance of this idea by switching the example to a 100% stocks portfolio of 50% US stocks and 50% international stocks to keep things simple. Let's assume the use of VTI for the US side. Here are a few options I'll propose for the international side. First, 100% VXUS. Again, we know this is about a 3-to-1 ratio of developed markets to emerging markets. Secondly, 50% VEA and 50% VWO, half developed markets, half emerging markets. And thirdly, 100% VWO, all emerging markets, no developed markets. Here's how these three options worked out historically from 1995 through 2021. As we'd expect, based on the aforementioned geographical correlations and risk premium of emerging markets, we can see that overweighting emerging markets relative to their global market weight has resulted in greater general returns and risk-adjusted returns historically. So does this mean US investors should use emerging markets for their entire international stocks position? Probably not. Again, we wouldn't want to miss out on all the developed countries around the world. That said, it shows we can probably rely reliably expect a greater diversification benefit and higher returns over the long term by giving a little more weight to emerging markets. I keep it pretty simple and just give equal weight to developed markets and emerging markets, i.e. a 1-to-1 ratio, instead of VXUS's 3-to-1 ratio. How do you weight developed markets and emerging markets in your portfolio? Let me know in the comments.